house. Does that make sense?
It still makes sense to us for a lot of reasons. I think that naturally now, especially over the last month, when the perception of trade policy rhetoric has become reality and investors have started pricing in potentially deterioration in global growth prospects and fled to the U.S., it's become a big issue. But I actually think for the opposite reason, U.S. growth prospects are actually quite a bit stronger. Margins are extremely high relative to the globe. I mean, the U.S. premium is about 20% relative to the rest of the developed world.
Yeah.
The margin premium is closer to 40%. So you can make a big case for upside to U.S. stocks just based on growth prospects and brighter margins, as opposed to the best place to hide from risk, which I think is the real case that people make. It's a good place to hide from risk, but it's also a really great place to find growth, higher margins, better earnings and sales growth prospects than the rest of the world.
It's a really attractive story. Is the price of that story still cheap, or is it expensive?
Look, I think we got a bit of a reprieve from the it's too expensive story first half of this year. We would argue we're at the point of the business cycle where you shouldn't be relying on multiple to get you there, but we don't think it's a risk per se. Look, if the bond market moved quickly way through your target, then maybe we'd have to talk about that multiple. I don't think it's a reason to own stocks, but I don't think it's a reason to be afraid of them.
Interestingly, in fixed income, I hear a lot about late cycles and start thinking about liquidity.
Yep.
Do you see that in the equity market?
Yeah, we are seeing it. Actually, the factor portfolio that's based on liquidity in the Bloomberg terminal started outperforming in October.
Wow.
For the first time in the cycle, which does suggest one of two things. Either investors are trading for more liquid names in an environment where suddenly we do have real tightening. Obviously, last year, the tightening process started to accelerate a little bit. It's accelerating even more this year. But coincidentally or not coincidentally, this portfolio started outperforming right around the time the Fed started QT. So the shift from QE to QT started to push investors into the more liquid names in the equity market. Unfortunately, and quite ominously, the last time this happened was 2008.
Oh, there we go.
So we have to get a little bit concerned that maybe either investors are pricing in too much risk, they're getting too liquid because they're overly concerned about the impact of QT on equities, or it is simply just a shift into the more liquid names, because the less liquid names have outperformed by a country mile for the most of this.
It says something that 10 years later we're still conditioned by just hearing the numbers 2008. And then all of a sudden people get jittery now.
Right.
Still, 10 years later.
It's 10 years. I mean, that's a lifetime for not me, but a lot of my colleagues. That's a lifetime. And I think this has been an incredibly slow cycle. And as I talk to clients, we want to have a long perspective. We want to have a long-term perspective. But it seems like people really want to, talk about hasten the end of days, basically. I think there's still a long runway to go based on where we are. And I think most economic consensus views would agree with that. Equities are on the expensive side, but as I said before, I don't think that's the risk.
But as Gina pointed out, and I want to dig into this, going towards the liquid names, is that a short burst of risk aversion, or is that something more ominous taking place here?
That's a really good question. My guess would be it's a short burst of risk aversion. We still have a lot of concentration in the index, which I think is a risk. And in some ways, some of the jitters we've seen this month have been in some of the crowded names. So maybe those become less important in the portfolio. Maybe you get a little broadening out of leadership. I think those would be healthy signs.
I hear this in the fixed income space all the time as well. In fact, I've heard it in the fixed income space before. The equity story really started to emerge. Get to liquidity. That's going to be the late cycle story you really want to start to appreciate. Liquidity, maybe more so than leverage. Is that what you hear in fixed income too, Matt?
Well, the liquidity picture is starting to deteriorate, but it's a slow process. Remember, the central banks are winding down their balance sheets, or they're certainly slowing the pace of the increase in their balance sheets in a very slow rate. So it's a slow-moving animal at this point. But when I look at the Treasury curve itself, what I find interesting is that it is agreeing with the next couple of years. Look, growth will be fine. That's why the two-year Treasury yield keeps inching higher. But when we go beyond the next couple of years, that's when the picture becomes more murky, right? That's why we see the yield curve flattening to new lows today.
What's the upside on the two-year yield right now?
Well, look, I think, again, it depends heavily on how far the Fed is able to take policy. We've been treading water around 2.5%. You could maybe get to 2.75. Exactly. I think you could possibly push that up to 2.75 on the spot 2-year, but eventually the Fed's going to stop hiking. They'll reach a neutral rate. Perhaps they will go on hold. Perhaps they'll hike a couple more times.
Yeah.
But we're getting close to that terminal level.
5 minutes into the session this Thursday morning, stocks positive, up by about 0.5%. Let's get you some movers, shall we? and cross over to Abigail Doolittle.
And helping those gains, Praxair shares of the gas company popping higher, up 2.7% on the news that they have sold their European industrial gas plants to Japan's Teo for $6 billion. Now, this makes it more likely that their $45 billion merger with Linde will go through, considering that certain overhangs, antitrust overhangs, could be removed. Investors liking it. Turning to the aircraft space, a little bit of a mixed picture here. Brazil's Embraer down 2.6%, Boeing up 0.7%. This in the news of a $4.8 billion JV between the two companies. They will produce smaller commercial aircraft. Boeing will have 80% control of that JV. This, of course, doesn't come as much of a surprise. These companies have been in talks for about a year around some sort of deal. This is the deal. And then finally, the U.S. automakers popping higher here on this Thursday. GM, Ford, and Fiat Chrysler on the chatter that the U.S. may not impose tariffs on foreign autos. A bit of a reversal of a threat from President Trump just 2 weeks ago. We see Fiat Chrysler really popping higher the most, up 6.6. This also represents an upgrade over at Credit Suisse to a buy from a hold, saying that the recent sell-off has been severe.
Abigail, great work. It's one of the sectors under the trade spotlight. It's the autos. Another sector under the trade spotlight is the chip stocks. Let's get across to Bloomberg's Taylor Riggs. Taylor.
John, and interestingly enough, the chip stocks are catching a little bit of a bid today, even though a lot of their revenue comes from China. Take a look at Qualcomm and Intel here. Qualcomm, 65% of its revenue comes from China. Intel gets 24% of its revenue from China, but still, nonetheless, catching a bid after positive news from Micron and news that they might be able to limit the impact that it's having on China's crackdown from the chip makers. So you can see Micron there. As you know, on Tuesday, a Chinese court temporarily banned Micron chip sales in a fight over intellectual property. That pushed the shares lower, but you are getting a little bit of a recovery today. You had analysts come out this morning and defend the stock. Micron, the company itself, came out at 8 a.m. and said, you know what, this court injunction will only affect 1% of our quarterly revenue, and they reaffirmed their quarterly revenue guidance still at $8 to $8.4 billion. So even though they get more than half their revenue from China, starting to defend themselves a little bit, John.
Taylor, nice work. Let's get the bull case, shall we? A little bit more on it on Micron. Vijay Rakesh Mizuo, Managing Director, joining us now on the phone. He has a buy on shares of Micron with a $72 price target. Vijay, great to catch up with you. Walk me through what this court decision in China does mean and what it doesn't mean.
Yeah, thanks for having me on. So I think if you look at the China tariffs, obviously it's a near-term overhang on semi-names, but really China does not have a lot of domestic capacity or capability to make memory or AI or computing processors. So if they start putting tariffs and hurt the PC or handset supply chain, that if you look at the PC handset supply chain, 50 to 60% of the demand or build is actually in China from an ODM standpoint. So it could actually end up hurting themselves. So we think it's a double-edged sword. So there's a lot of posturing in this market, but really tangible or material retaliation, we think, is probably not happening here.
Vijay, I remember it wasn't so long ago that Micron was a takeover by a Chinese target, takeover target by a Chinese company, rather. And several years later, have the Chinese been able to invest and basically come up with their own heavyweights to take on the likes of Intel, the likes of Micron?
That's a good question. I think even today we see, as you look at 2019, 2020, we really don't see any China capacity or capability to do competitive DRAM. We think most of the DRAM capacity coming out will be at much higher nodes, much in terms of cost, very cost ineffective versus Micron. So it won't impact the DRAM supply chain even if you look 2 years out.
Vijay, it's really difficult for a lot of people to get a handle on what these tariffs will mean for some of these companies. If you take Intel just as an example, as you all know, the last stage of the production process takes place in China, but it's a very small part of the production process. Do they get hit by US tariffs coming from China into the United States? Have we got a handle on these kind of things yet?
Yeah, we don't think they'll get hit as much, primarily for the same reason, because a lot of the PC handset supply chain is in China. So if they start hurting Intel, it actually hurts the PC handset supply chain. So that actually ends up hurting a lot of the Chinese companies because they do a lot of the contract assembly and contract manufacturing. So so we think it's again a lot of posturing it probably won't affect these guys.
So, Vijay, I won't ask you to get a crystal ball out and sort of predict what's going to happen with this trade story, because anyone that says they know is probably lying. I do want to try and understand from you, though, for the semi sector, for the chip sector, where you think this is going to mostly play out. Is it with the blunt tool of tariffs? Is it in the court? Is it somewhere else?
Yeah, I think for the semi names, as you look at second half, it's basically a demand story. Demand continues to be intact. Inventory across the board in semis seem to be at or below normal levels. In memory especially, pricing is tight. So tariffs definitely a little bit of an overhang, but we don't think it'll factor into, it won't factor in a lot into a lot of the investors' outlook, because really for them to impose tariff, it ends up hurting them, and locally they do not have the capacity to compete with many of the semi names, especially the Intels or the Microns that you talked about.
Vijay, it's a really strong point. We appreciate your insight, and hopefully we can get you back on a program again soon. Vijay Rakesh of Mizuho. And Gina, just the chips and the semis, just an example of how difficult it is to really work out who gets hit from what and where.
Yeah, and I think this is really the trouble for tech going forward, right? I think investors have absolutely punished industrials, consistently punished industrials, and said this is going to be the area of greatest trade risk. To a secondary degree, they've punished some consumer staples companies because the dollar's been so strong. Tech has sort of been sheltered from this risk because of the stronger secular growth and stronger earnings trends and more consistent earnings trends in tech. But as the trade rhetoric comes out and becomes reality, it is going to be an area of risk because the sector has been so strong and has been somewhat sheltered. We do still have tech at the top of our sector scorecard list. It's still got really strong earnings trends, really strong price momentum, but I am worried about this ongoing risk kind of weighing on the tolerance.
It's been somewhat of a double-edged sword, though, for tech, access to Chinese markets, because for some of the big internet names, the negative was they couldn't get access to Chinese markets, but I guess that's a positive now because you don't have the negative overhang over some of those big names.
Yeah, and the companies have made the decision where they can go in profitably. The end game, if we think there's an end game that isn't a trade war that does lead to some more IP protection, that's probably a net positive.
Yeah.
There are a lot of well-valued, top value subsectors in the industry, but we think in the sector, but we think there's probably still some room for growth, and we think some of these places are a little bit more defensive now than they've been in the past in software within the tech space, which is also an overweight for us. But software has become a focus for us, where we think there actually is room actually for some multiple expansion still as they go to a less cyclical business model.
Gina, just to sort of wind things down in this part of the conversation, a lot of smart people have made a few buckets on the S&P 500 of stocks with big exposure to China and Chinese revenue, and those stocks have been battered.
Yeah.
And I just wonder if they've been battered enough. Are we at an inflection point now where a lot of it is already in the price?
Well, what I can say is I do think with a high degree of confidence that the current framework for trade is in the price. What we don't know is what the retaliation from China looks like, and then further retaliation from the U.S. looks like, and I don't think you can possibly price that until you get more news of that, right? But what we do know is that what's happening for tomorrow is probably in the price.
Gina Martin-Adams, a reflection of perhaps the early price action this morning. She's going to stick with us alongside Noah Weisberger. Matt Hornback and Morgan Stanley, we're letting the UK. Thank you very much for joining us this morning, Matt. In the markets, we're about 14 minutes into the session, shaping up as follows this Thursday. Up 0.5%, erasing the weekly loss and transforming it into a little bit of a weekly gain. On the Dow, we're up by 0.6%. In the bond market, the situation as follows. Treasury yields unchanged at 283. And in FX, it's been largely, with the exception of the Japanese yen, a story of dollar weakness, captured by euro dollar approaching 117. From New York, this is Bloomberg.
This is Bloomberg Markets The Open. I'm Kaylee Lyons here in the Hewlett-Packard Enterprise Green Room. Coming up on Bloomberg Markets Balance of Power, Anthony Scaramucci, former White House Communications Director.
Saudi Arabia cutting oil prices for the month of August following President Donald Trump's tweet demanding OPEC do more to stabilize prices. Trump tweeting the OPEC monopoly must remember that gas prices are up and they're doing little to help. If anything, they're driving prices higher as the United States defends many of their members for very little dollars. This must be a two-way street. Reduce pricing now. Bloomberg's Will Kennedy joining me now from London. So, Will, I imagine it's a whole lot more nuanced than some headlines would suggest. Has the president got what he wants to some extent with the actions this morning that we're learning from Aramco?
It's a little marginal, but it's significant. So, in essence, they'll only cut prices by $20 a barrel, and this is quite an arcane part of the oil market. But it's certainly a signal that Saudi Arabia is taking the president's concerns seriously. It's a signal that they're about to put more oil into the market, so they need it to be competitively priced. So it will go some way to showing Saudi's intent. Whether it's enough to feed through into pump prices in the States, probably not. But we've had another interesting reaction today, John, from a second OPEC member, Iran. And Iran is less keen, as you can imagine, to keep President Trump happy. In fact, the Iran's OPEC governor has even sort of trolled the president back. He said in a tweet, your tweets have driven up prices by at least $10 a barrel. Please stop, or otherwise it will go even higher. So I think what you're seeing, in essence, is that in some senses Trump has succeeded. He succeeded in changing Saudi oil policy. You'll remember in the spring, the Saudis have been content to see prices keep going up. Now they're wanting to increase production. They're wanting to put a lid on prices, bring prices down a little. But it hasn't worked because of Iran. And at the same time, the president is also insisting on sanctions on Iranian oil production. That's making people in the market nervous. And they're also nervous that if the Saudis go to full production to offset those Iranian cuts, that there won't be any spare capacity left in the market. And that will make people nervous about how we react to future supply cuts.
Hey, Will, some fantastic coverage coming from your team over the last couple of months on this story, so thank you very much for that contribution. Michael Cohen joining us now, Barclays Head of Energy Markets Research, joining us on the phone. And Michael, a lot of people will ask whether the president is being successful here, and some people would say to some extent, some people would say no. Look at the crude price and it's heading north still. We're only just a little bit softer in today's session. Your thoughts, Michael?
Sure. Well, I mean, as with any day that we have a trading day, prices can be influenced by a whole host of different factors. And I think what we have going on right now is exactly that. And although they've cut their OSPs, or their official selling prices, into the U.S. And to some other key markets, these official selling prices tend to be a lagging indicator of the fundamental market backdrop. So the Saudis react to that backdrop and price accordingly. So I wouldn't necessarily say that they're reacting specifically to Trump's tweet, but I agree with Will in that this is clearly something that they want to be shown as reacting to what Trump would like, and there is that clear U.S.-Saudi relationship that they don't want to sacrifice. So I think at this point, on a day like today, where we have a bunch of different macro events, we've got the Libya disruption that is not getting resolved yet, that Trump really hasn't addressed in any of his tweets so far. All of this is keeping prices elevated during the summer season.
You mentioned the Saudi relationship, the Iranian relationship, very, very different. Rouhani very recently, the Iranian leader, sort of in a more nuanced way, suggesting that the Strait is something that could come under a little bit more pressure. The Strait of Hormuz, that is, Michael. And I just wonder how that tension is going to play out in the coming months.
Yeah, I would agree that this is something that the market is going to be extremely worried about. The Strait, passages through that Strait, there's, upwards of 20 million barrels a day of oil that goes through it. At a certain point, even if it's not actually possible for them to do it, for the Iranians to do it, if the market believes that it is possible, then it's going to react as a result. And this is why everyone is so concerned concerned about the low levels of spare capacity in the system if Saudi Arabia does indeed go up to 2 million, does indeed surge its production by 2 million barrels a day. But what I want to make sure to highlight here is that the United Arab Emirates actually noted in a release a day or two ago that they could conceivably raise their output up to 3.5 million barrels a day. So I think what we need to be concerned about is how accurate these levels and these assessments of spare capacity are. Conceivably, the spare capacity levels have been a very good predictor of where oil prices are going to go. And if we have elections in Nigeria in Q1 coming up, and then we have further disruption to Venezuelan supply, it's going to be a very tight market. But I think over the course of the next 6 months, we see a slightly more weaker market outlook ahead as the fundamentals take hold and the market absorbs this extra Saudi production that is already being put onto the market.
Michael Cohen at Barclays, great to have you with us on the programme to get your insight on what is happening. Two conflicting sort of points of view on what's happening in the commodity market at the moment. Gina Martin-Adams of Bloomberg Intelligence still with me, and Noah Weisberger of AB still with us as well. Gina, is the equity market capturing the upside we've seen in crude, or is there just this huge element of doubt hanging over the market as to what's coming next?
I think I'm about 50-50 on that answer. Unfortunately, I don't have a real clear read because the energy stocks have done really well up until the last month or so when they've corrected a little bit from extremely overbought conditions. And now they're kind of in a sideways trading range. And there's not a lot of conviction that oil prices can continue to go higher, but there's also support for oil prices to stay where they are. As a result, the stocks have kind of languished here. I mean, frankly, I think, though, when you get into earnings season, you could see more upside to energy prices or energy stocks simply because the earnings are going to look phenomenal. I mean, far beyond any other sector in the index, energy sector earnings are printing very, very rapid growth. And really key, the companies are actually deploying that capital and cash back to shareholders at a faster pace than most other sectors. So those are the two factors that I think will keep energy stocks moving in a relatively positive direction, even if oil prices kind of languish here.
Gina Martin-Adams, it's been great to catch up with you. To Noah Weisberger of AB, thank you very much for your time today as well. From New York, with equities back on the front foot, the trade conversation front and centre, you're watching Bloomberg TV. Here's your trading diary at 2 p.m. Eastern. The Fed releasing minutes from its June meeting at midnight, 1 minute past midnight. US tariffs on $34 billion of Chinese goods set to kick in. And on Friday, it's Jobs Day here in the United States. So the USTR confirming that those China tariffs are scheduled to start at 1 minute past midnight Friday. Joining us tomorrow, don't miss this lineup for full, complete coverage and analysis of the jobs report. Mohammed Al-Arian, Bloomberg opinion columnist right here in New York City, alongside Rick Reader, BlackRock's global fixed income CIO. A stacked lineup ahead of payrolls Friday. With equities positive, this was the countdown to the open. You're watching Bloomberg TV.
Finally. Bon, allez, je m'arrête pour aujourd'hui.